Good afternoon. Welcome back for another session talking about business structuring. We're going to take it a step further than we have before. So far we've talked about we always start with the trust. That's going to be our foundation, okay? And then generally, if you have California property, you have that in a limited partnership. If you have out-of-state property, we're going to put that into an LLC, okay? The California Limited Partnership has a Wyoming LLC to act as the general partner for protection's sake. So now let's say that you have 15 properties in 4 different states. You have a business or 2, you have investment accounts, you have some excess monies, and some cryptocurrency, okay? So those are the kind of things that we're working with now. What would we do to make this work out best? Well, first of all, we know that we're not going to want all of the properties into one entity. Why? Because once again, as we talked about before, we don't want all of our eggs in one basket, all of our apples in one barrel. And the reason is we don't want something that happens to one of them to affect all of them. And so what you do is in your mind, you kind of think, how comfortable am I with having properties together? And you have to come up with the idea of how many you're willing and comfortable with having together. In my mind, I go anywhere from 5 to 6 properties. I can probably feel okay having them in one entity. Now, I've had clients that said, you know what, I don't want any property to affect any other property, and so I'm going to put them all into separate LLCs or FLPs. And so if you had 20 of those, you're going to have 20 entities. Well, it's going to give you protection, there's no doubt. That would probably be the best protection, but you're going to have to do a tax return for each one, and you're not going to get much more tax benefit after the first 3 or 4 entities. After that, you can get the same tax benefits with one entity. And so that's not going to work as well. So protection is going to be better. Taxes are not going to be better. You're going to have the cost of being able to maintain all of those entities. And if you're one of those that just loves taking care of entities, that's a wonderful way to go. In fact, in Texas, we actually would create an LLC or an FLP, and we put each of the properties into an LLC and put those LLCs into our FLP or LLC in Texas as a main holder of all of those. And so everything is separated, and yet we're able to use all the tax benefits together. I'm going to show you how to do that in another way that might be even more beneficial, but that's something that we can do. So here we go. We already know that we've got some California property, so we know we're going to have a limited partnership, okay? The limited partnership will have an LLC as the general partner. The limited partner will end up being your trust, is what's going to happen. We have the trust, we have the FLP. Now, we have these properties in 4 different other states other than California. And so what we've done for clients in the past is that we will actually... 15 properties, 4 states. We'll probably set up 3 or 4 LLCs in different states to hold these properties. Well, what if you had more states? What if you had 8 states, or all 15 properties were all in different states? With 15 properties, we'd probably still set up 4 entities. Possibly one, depending on where they are, but possibly one in Florida, possibly one in Montana, possibly one in Utah, possibly one in Ohio. And so it depends on where the properties are so that we're going to determine what it is. And so let's say we set up these 4 entities, and we put 3 to 4 properties in each one of these entities. Now what happens, we sit there and say, wow, we've got a bunch of entities out there. It's like I've got to sit there and juggle all these things. It seems really tough to remember, what about that entity? What about this entity? How do they work together? What if that one has a profit and this one has a loss? We have all these different issues we got to think about. So in this case, what we do is we have one more entity, either a Wyoming or a Utah or possibly a Texas LLC. So what we do is this is going to be called a holding company. and it's actually going to hold our interest in all the different entities that we have. So we're going to have our limited partnership, which we want to keep separate from everything that's going on outside of California. We're going to have a holding company that's going to hold the all four businesses that we have, or all the four LLCs that are going to hold these properties throughout the United States. Now, all the profits, all the losses, all flow into the same holding company. So when the K-1s are sent out, they're sent out to the holding company. And if LLC 1 has a loss of $100,000 and LLC 2 has a profit of $100,000, we should be able to write that off against each other and basically come to a non-taxable event in that case. And so, but that's what we want to do, is we want to take care of this. This also gives us the ability to control and manage that many entities all at the same time. So this is how it would end up. Now you also have this investment company. Personally, I would go ahead and open up an LLC just for money investments. Why? Because there's no liability. There's no liability. So if what's going to happen? The stock market crashes. It doesn't cause any liability, but somebody falls down the steps on one of your houses. We do have liability. We don't really want our money assets to have no liability at all to be combined with assets that have liability. This is the reason why we don't actually put cars and vehicles most of the time into our LLC or FLP. The reason is because it's just too dangerous. I mean, I've heard that 60% of all the lawsuits out there are caused by cars, car accidents and things. So why would you put something that has so much danger in with things like real property and investment accounts that have low liability on it? I compare it to having by creating a safety deposit box, okay? And so in the safety deposit box, we want to put things that we want to safeguard. And so we put your wife's jewelry in there, we put her pearls in there, we put her ring in there, we put your investment deed papers in there, and then you say, oh, I've got this stick of dynamite, I want to protect it too. So you stick it in that same box? No. The stick of dynamite could blow up the whole box and you lose everything. So you put a stick of dynamite in a different box, someplace where it can't affect everything else. So that's kind of what we did. I remember I had this one client. We did a two limited partnerships because it was in California, and one of them we called the low danger LD limited partnership, and the other one is the HD limited partnership, the high danger limited partnership. And so he had a recycle business, and so what he did is we put all of the equipment that ground everything up into the high danger. All you need is your employee to fall into one of those, and all of a sudden he looks just like the rest of the scrap. And so that's really dangerous. And yet he's had some properties and he had some monies that were not dangerous. And so we put non-dangerous things into one, we put dangerous things in another, but you don't keep them in the same box. So the deal is, in this case, we would want to go ahead, unless we have some dangerous thing going on out there, we're going to go ahead and have this holding company. It's going to hold all the business and entities for out of state. And so in the end, what happens is your trust is going to be the limited partner of the FLP and the owner of the holding company. Okay? Then what happens is the FLP will hold the properties and California business interests in California. The holding company will hold the properties, not the properties, but the LLCs that hold properties out of state, and the investment account and any business interests outside of California, and that will be held by that LLC. So you have two entities your trust will own. Between the trust, between the FLP and the holding company, you're going to own all the other properties, and that way you're going to be at maximum benefits by being able to take profits and losses, write them off against each other, and be able to get a better tax benefit in the end. So that's kind of going another step. And so there's ways to go forward. Once again, if we're going to do something like this, you definitely need to talk to your your legal advisor, the one that's going to be able to say, this is how many entities we need, this is how we're going to hold it. We need to do that because everybody's needs are different. And you may have something that you're doing that's very dangerous that you definitely don't want to get involved with anything else. I had one client who had an LLC just to hold his business trucks because that's where the liability was. Then his businesses and properties were in different entities. So we can do these type of things. That's the type of idea that you have. So now they're protected. The properties are protected. The money is protected. You're getting maximum tax benefits, and you get to enjoy what it is. And guess what? That target that you had on your back in the beginning is no longer there because you don't own anything that anybody can touch. So that's where we're trying to go from here. Come on back. We're going to be telling you a little bit more about different type of trusts and different type of strategies that we can use to in estate planning and long-term care and things like that. And we've got more information coming.